Welcome to another week of Lunch Money brought to you by Sharesies. At Sharesies, our purpose is to create the most financially empowered generation.
And for those of you who are new to Lunch Money, we do these every Thursday at lunchtime, and it's a place where you as investors can hear from the people leading some of the companies available on Sharesies and other investing experts like we have today.
Lunch Money is also available as a podcast on Spotify, Apple Podcasts, and Google Podcasts. So if you're listening to the podcast, please take a moment to leave a rating and comment on Apple Podcasts. We'd really appreciate it. So I'm Samara. I'm an operations associate, and I'm joined here today by Chris.
Yeah, kia ora. I am Chris. I'm a product owner in the new markets team here at Sharesies. And we are stoked to be with you today. So before we get into things, we've got a small legal disclaimer, which is that investing involves risk. You aren't guaranteed to make money, and you might lose the money you started with. Any information we provide is general only and current at the time. And if you're looking for help with your investment choices, we recommend talking to a licensed financial advice provider. Oh, got that one out. We won't be providing any personalized advice as a part of this webinar.
Also, just a quick reminder, if you have any questions for Mary, you can submit them through the Ask a Question button down below. Don't leave questions in the discussion area as they're likely to get missed.
And please be kind and respectful towards our speakers and your fellow viewers. Otherwise, we'll take steps to remove you from the webinar, and we don't want to do that.
So let's get started. Today we are joined by Mary Holm. Mary is a columnist, author, and commentator on all things investing and personal finance. We'll be talking about how to plan for uncertainty and discuss some ways to put together an investment portfolio. Welcome, Mary.
Thanks very much, Samara.
Hi, Mary. Thanks for joining us.
Hi, Chris. Hi, thank you.
Cool. So before we get started, we should say that we're running a giveaway today. If you submit a question to Mary, either here in Crowdcast or if you've done it earlier in the week in Facebook, you'll go into a draw to win one of Mary's books, which is called A Richer You, How to Make the Most of Your Money.
That's what it looks like.
There it is. And we'll choose 3 people randomly afterwards who will win if you submit a question.
And just one more super quick note, we are running an audience survey. So if you answer it and provide your details, you go into the draw to win a $50 top up to your Sharesies wallet. 5 people will win those randomly, so be in to win. We'll pop the link in this chat, but you'll also get an email with the link after the session.
Cool. Okay, big intro. I think we're ready to go. So first of all, Mary, thank you so much for joining us today. It's a real pleasure to have you here. We're really stoked that you've made the time to come and join us. And we're keen to chat about how to build an investment portfolio. So where we thought we might start is that one of the most common questions we receive here at Sharesies from investors is, how do I choose what to invest in? And how would you go about answering that question?
Well, personally, I tend to just invest in share funds, which I know you can do through Sharesies, rather than buying individual shares. But I think my dad used to love to buy individual shares, and I think it's a very personal thing. I mean, for some people, it's kind of like a hobby or an interest of theirs to research companies and decide which ones they want to invest in, and that's great. A lot of research suggests they won't do any better than people who just go into a share fund on average. I mean, some people that pick shares do better, of course, but on average, they actually tend to do worse than people that go into a broad-based share fund. But, that either way, people do pretty well. It's just a question of being patient, getting in there and staying in there. Yeah.
Cool. Well, that leads really well onto one of the next questions, which is when constructing an investment portfolio, we like to talk about investors' goals, their time horizon and their risk appetite. And so I was wondering if you could talk to what a time horizon is and how that might relate to risk and how someone might construct their portfolio.
Yeah, there are 2 issues, I think, when you're deciding what to invest in. One is when you expect to spend the money, so that's your time horizon broadly, and the other is your personality and how you can cope with risk. So I say to everybody, even if you're quite happy to take a lot of risk, if you're planning to spend the money within the next couple of years, 2-3 years, you're really best to go with very low risk investments. I mean, bank term deposits maybe, or but you can do, something a bit more interesting than that is to go into, say, a KiwiSaver fund or a non-KiwiSaver fund that is a cash fund that invests only in cash type assets. And they're the very lowest risk ones. And you probably get a little bit higher return than you will in a bank term deposit by doing that. But then people who think they're going to spend the money between, say, 3 and 10 years roughly, that sort of period, then it's quite good for them to be investing in a bond fund or a middle risk KiwiSaver or other managed fund. Or you can do that yourself by having some of your money in bonds and some in shares. But you don't, if it's money you're planning to spend within 10 years, it's not a good idea to have much of it in shares, because there's quite a chance that when you go to spend it, its value will have fallen. It's really, one of the very basic rules about investing is don't get yourself into a position where you're forced to sell something. So if you know that you're going to need the money within less than 10 years, it's not a very good idea to have it in shares, really, not unless you're happy to gamble. But longer term money, shares are great. Yeah.
Cool. And how would someone be able to tell if their investment portfolio is working towards achieving their goals?
Yeah, well, I suppose that's just having a look at it every now and then. Although I don't recommend checking your progress too frequently, actually. I mean, Warren Buffett, who many people will have heard of, one of the richest people in the world, who got rich by investing in shares, and through his company Berkshire Hathaway, a lot of other people have got rich in America. And he is a great one for quotes. And he said some years back, put your share certificates in the bottom drawer and don't look at them for 5 years. That's his kind of philosophy on it. These days we don't actually have share certificates as such, but the idea is still there. It's not a good idea to be looking very often at how well you're doing, which is one reason why I actually feel a bit unhappy with bank KiwiSaver providers, because they usually put, when people log into their bank account, up comes their KiwiSaver balance. And that used to be great for people when the markets were just going up and up and up. That, oh, good, it's gone up a bit more today. Last year, when we had the COVID crash, and people were really panicking, and I think it was bad news that people were looking at their balance that closely. I didn't look at my KiwiSaver balance through that COVID crash. I just thought, oh yeah, I'll look at it sometime soon, and it will have gone down a bit. But so that's a test for you actually about whether you're investing in the right place. If you would worry if you looked at your balance and it had gone down, that means you're not doing the right thing, because it should be long-term money where you're just saying, oh, okay, it's gone down, it'll come back up again, that's cool. Yeah.
Awesome. Thanks, Mary. So we're just going to take some questions from the audience that we've got here.
Yeah.
So a question from Viv in the audience. Hi, Mary. I'm wondering how often you recommend rebalancing your investment portfolio. Thanks.
Yeah. Yes, no, that's an interesting one. So what Viv is talking about is, let's say when you're looking at your time horizons, etc., you've got 50% of your savings in shares and 20% in bonds and 30% in short-term money. And then if the share market's doing really well, after a while, you'll have more than 50% in shares. It'll be going up to 55, 60% just because that particular balance is growing. So then you, every now and then, in that situation, might want to sell some of your shares and move that money into the other allocations. And obviously the reverse if the share market were going down. I reckon once a year or less, really, probably. I mean, every time you're transacting, it's a hassle and it costs a bit, although I know on Sharesies it doesn't cost a lot, but still, Because the thing is, people, if you rebalance too often, quite often, next week the market will do the opposite and you will have to move your money back again. So once a year, once every 2 years probably is often enough, I think. Yeah.
That's great. Thank you. So we've talked about investing in shares. How would you say that fits within someone's wider wealth development picture, including other investments, say like property?
Yeah. I mean, as we know, many New Zealanders love investing in property and, in rental property usually. And in recent years, they've done very well out of it because the house prices have gone so crazy. Although having said that, what a lot of people don't realise is the share markets have also done fantastically in the last 10 years, New Zealand and world share markets. And so both share and property investments have done really well. And they're both, though, subject to price falls. And I was just looking last night, actually, since 2000, property prices in New Zealand have gone down 3 times. Once in the year 2000, once in 2008 or 9 in the global financial crisis, and once a couple of years after that. And they will go down again. People just they just say property prices don't go down, and it's not true. So we've got the shares and the property, which are, if you were to invest in property without a mortgage, which is pretty unusual, although, some people are in that situation where they can buy a rental property without a mortgage, then generally speaking, that'll be lower risk than investing in shares. Although, if you're investing in only one property, that there is the lack of diversification, which can be a problem. And by the time lack of diversification being a problem, because if you're in a single property, it can suddenly, things happen that people just don't predict, like a gang moves next door or something like that, because they can move into some very nice suburban houses because they've got lots of money, or you discover that the place is leaky, or there are things that people just can't predict happening to a single property. So that's one risk. But there's also, because nearly everybody borrows to invest in property, and hardly anybody borrows to invest in shares, that's pretty unusual. Borrowing to invest in anything ups the ante. If the investment goes well, you get a gain on the bank's money as well as your money, which is terrific. And that's why rental property has done so well. But if things go wrong and you end up being forced to sell either a property or shares, if you borrow to invest in shares, then you can end up with, you sell the property or the shares for less than you paid for them, you've made a loss, and you've still got a debt to pay back. And that's what happened in the 87 share market crash in New Zealand. A lot of people had borrowed to invest in shares, and that's why people got very anti-shares for a long time after that, because they'd gone over the top. They'd borrowed to invest and gone into some of these mad companies that had also borrowed to invest. And so you had sort of gearing on top of gearing, and that's why things went so horrible. These days, people are not generally borrowing to invest in shares, and the companies they're investing in are good, solid companies. And so it's a whole different ball game, much, much lower risk than it was back then.
Cool.
Is that enough?
So that's perfect. Yeah. This leads really nicely into a question from Rebecca in the audience. How do you balance paying down your mortgage and regularly investing? Which is better to prioritise?
Yeah, no, that's a really good question, and it's come up in my Herald Q&A column quite a lot lately. Generally speaking, in the past, I've always said, look, just pay down your mortgage, because that's a really good, solid investment. It makes you more secure. If you can get rid of the mortgage earlier, then at a younger age, then you can get into very serious retirement savings at that point, etc. And you can often, if you pay down extra off a mortgage, you can often borrow it back in a crisis. So that's the sort of way you can park your rainy day money. But the thing about paying down a mortgage is it's the equivalent. It improves your health in the same way as whatever the interest rate on the mortgage is. So to explain that, if the mortgage interest was 5%, then paying extra off the mortgage improves your wealth in the same way as an investment that earned you 5% after tax and after fees and all of that, and it's a low risk investment. So that's why it's so terrific. These days, with mortgages down at about 3%, people are saying, well, okay, paying down my mortgage is improving my wealth as much as 3% investment would, but 3% is not that much. I can do much better in shares or in rental property. And that's absolutely true. It's just that those other investments are higher risk. So they're higher risk and higher return. So it's up to you. There's never anything bad about paying down a mortgage. It's still a terrific thing to do. But if you're thinking, oh, I could take a bit more risk with my spare money, then maybe put it into KiwiSaver or other types of investments. Yeah.
Cool. Thank you, Mary. I think that leads us quite nicely onto a question around uncertainty. And I think this recent lockdown is a reminder that there's always uncertainty around, and particularly in investing. So the question is, how does someone prepare their investment portfolio for uncertain and volatile times?
Yeah, well, we've sort of covered that in that you want the riskier investments, the shares and property, to be money you don't need for 10 years. I say some people say 8 years, but some people also say 12 or more. So if the markets wobble around in the meantime, you really don't care. I mean, you'd rather they didn't, but you know that the long-term trajectory is always going to be up. It just is. It always has been, and there's no reason why we should expect that to change. So that's the main way to prepare for uncertainty, is just not to have riskier investments in. They've got to be long term. The riskier investments have got to be long term. Yeah.
Cool. Thank you. We might move on to a bit of the Q&A now. So we've gathered a bunch of questions from here on Crowdcast and from Facebook earlier in the week, and we'll run through them. So Sam, I think you might have the first one there.
Yeah, so we've got a question from Brad in the audience. What are the pros and cons of contributing more to your KiwiSaver or investing that money in your own share portfolio?
Yeah, now that's a good question. Everyone should, I reckon, be in KiwiSaver and put in as much as you need to get the maximum from the government and employers if you're an employee. So if you're not an employee, and this applies to people who are at home looking after little kids, or, it's not just the self-employed, everybody under 65, it's really a pity if you're not in KiwiSaver. Under 18s don't get government and employer money, but between 18 and 65, a real pity not to get that, because it multiplies the money you put in by 1.5 if you're self-employed, etc., or it roughly doubles your money if you're an employee. And what that means is instead of retiring with 200,000, you're going to retire with 400,000, or twice as much and twice as much coming back out, which people don't always realize. So it's hugely powerful. But Brad's question was, what about putting in more than it takes to get those rewards coming in from elsewhere? And it depends a bit on whether you like to tie up your money. Quite a lot of New Zealanders say, I like putting it into KiwiSaver because then I won't get my sticky fingers on it and spend it on a holiday or a car or whatever, because you can't get it out again except for a first home until 65. But if you're quite well disciplined person, and so you wouldn't be going in and taking that money out, then it's not a bad idea to put it in. I think he was talking about a share portfolio or an alternative investment, because you've got that access to the money. It's your returns are probably going to be roughly similar if you're going into the same sort of risk investment in or out of KiwiSaver. But I say to people sometimes say, well, look, I know that I won't need the money. I've got plenty of rainy day money and I've got other backups and all of that. But sometimes you want extra money because family member gets into trouble. I mean, things happen. Somebody might get an illness and the drugs for it aren't funded by Pharmac. And we've all heard stories about people spending $100,000 a year on that sort of money on drugs. You never know when that kind of thing might happen, or it might be a more positive thing. There might be you or somebody in your family wants to start up a company and they need seed money to do that. And, it's a great idea if you've got some money you can access to put into your niece's brand new company. So unless you're someone who's likely to raid the account and blow it on something that you regret later, then I think it's quite a good idea to have it outside KiwiSaver.
Cool. That's awesome. Thank you. I'm just going to jump to the next question. Yeah. I'm new to investing and still learning the ropes. Is it better to invest in index funds or ETFs, and how do they differ?
Now, ETFs sort of are index funds usually. An ETF is an exchange traded fund. So it's a managed fund in the same way that KiwiSaver funds are managed funds, and there's a whole lot of different sort of types of managed funds, and they all take a lot of different people's money and invest it in many, many different assets. Exchange traded funds are managed funds that are traded on the stock exchange. So when you invest in one of those, you're actually sort of buying like a share in the fund, but it's not really very different from buying a unit in, say, a KiwiSaver fund. They're very similar. Index funds are funds that invest only in the shares in the share market index, usually, and that can be a bond index, but it's usually, let's keep it simple, it's usually shares. And they are within KiwiSaver. Some of them are index funds, or they're sometimes called passive funds, because all the manager does is invest all the money in the shares in the share market index. So they're only trading if the index changes, which it does every now and then, but in a fairly slight sort of way. So they're very cheap to run. They're not doing any research on which companies to invest in, etc. And the research over the years shows that they're just as good an investment. I've had my long-term savings in index funds for decades, and I've never regretted doing that. So index funds and exchange traded funds, nearly all exchange traded funds are index funds, but there are also non-exchange traded index funds. Now there's plenty of other people out there who will argue with me, and we'll be arguing in our deathbeds probably about whether index funds, passive funds, are the best way to go. Lots and lots of people say no, the such and such a manager can pick which shares are going to do better than average. I'm going to go with them. And for a while they do. Some of them do. Some of the managers do worse than average. Of course, when you're looking at average, half of them are going to be worse in any period. You will get some active fund managers who do better than average for quite a long time, quite often. But once again, there's been heaps of research on this in America in particular, but around the world. The ones that do well don't keep on doing well. You can't tell because a fund's done really well in the past that it's going to do well in the future. Quite often, it's the opposite, actually. Yeah.
That's great. Thank you, Mary. The next question we had, actually, you've just covered perfectly there, so we won't ask it because it's looking at passive funds versus managed funds as well. So, the next question here from HQ is, when is a good time, or what is an indicator to sell an investment?
To sell an investment? I would say a good time to sell an investment is when you need the money, and not when the market's doing whatever it's doing. You want to just be planning to get, just by the time you're selling, you should be selling from a low risk portfolio, low risk section of your savings, like bank term deposits or a low risk fund at that point. So you've got your 10-year money in the high risk funds, and about once a year or so you move some of it down to the medium risk and some of that down to the low risk. So by the time you're selling, it's kind of irrelevant what's happening in the market. Now, some people argue, well, I do want to take some notice of what's going on in the market. And I would say, well, yeah, all right, but if you must, but then you should be being a contrarian investor and doing the exact opposite of what everyone else is doing. Because like in the COVID crash last year, or COVID downturn, there were people moving, quite a lot of them in KiwiSaver or in higher risk funds, moving their money into a medium or low risk fund because they saw their balance go down and they panicked. And that's terrible. If you do that, if you move your money down when the market's gone down, that you're taking that, making that loss real. Whereas if you just leave your money there, after a while it'll go back up again. There were some people though in the COVID downturn who were saying, well, I want to buy in the downturn rather than sell. I want to, these are called contrarian investors. They're doing the opposite of nearly everybody else. And that's not a bad thing to do because suddenly the shares are cheaper. At Shareises, I'm sure you probably saw, some people selling and some people buying during that period. Not everyone was doing the silly thing and selling. So it's not a bad thing to do. But once again, the research, people who have studied this, I did an MBA at the University of Chicago, and the finance professors there, you do this kind of research and look at what people have done over the years, and people who get in and out of the markets try to time things do a lot worse on average than the people who do what I've done, which is just stick your money in there and go and read some novels or go to the beach. I mean, honestly, it's better for your investment than watching the markets too closely.
Awesome. Thanks, Mary. Our next question is, do you have recommendations on resources or books for beginners? And that one's from Georgia.
Oh, look, you can't ask that of an author because, of course, I'm going to say read my books. I've got this one that we're giving away, A Richer You, but also another sort of more basic one, perhaps called Rich Enough, that's out there. And that covers the basics, really. You can't really expect me to say another book's better because I put what I think was best into my book, if you see what I mean. Other people will say their books are better, but sorry.
That was a perfect time for a plug of your book, Mary.
It was,
Well
yeah. That was probably my auntie who said that. Thank you.
Yeah, that was definitely not a setup.
No, it wasn't. No.
I love giving the advice for investment advice of going to the beach and reading a book. I think that is lovely.
Look, it's really, yeah. Warren Buffett, same thing. Put it in the bottom drawer and leave it, yeah.
Mm-hmm. Cool. Right. So the next question we have here is from Trace, and it reads, I've heard it's best to view at least 5 or 10 years of a company's history before considering an investment. On that basis, no one would ever invest in an IPO, initial public offering, which is when a company first lists on an exchange. What should we look out for, good or bad, when considering an IPO?
Yeah, so an IPO, initial public offering, yes, when a company first lists, as you say, and sometimes, quite often, they're quite small companies that are growing fast, although not always. Sometimes they've been, the founders and their family have funded the company and it's growing and they might want to get out, they might want to retire or something like that, and so they're suddenly saying, okay, we're going to list on the stock exchange now. And there'll be quite a lot of information available about the company at that point. You might want to consider research. In fact, I was just reading a paper about this in the last week. The average IPO doesn't turn out to be a good investment. And this guy was writing about My Food Bag, which has not turned out to be that good, a fairly recent high-profile IPO that has not turned out to be a very good investment, and there's lots of them, but some do. So it's as much a gamble as any other gamble, really. People think they're going to get a cheap price going into an IPO, and the good ones, then the market goes up within hours of them actually listing, and people sometimes sell their shares the next day and make a profit, and that's the stories people hear. But it doesn't always work out that way, and so it's quite high risk strategy. It's the kind of thing to do as a bit of fun. There's nothing wrong with having a bit of fun with a little bit of your money and 5% of your savings or less. You flick it into an IPO and it might work and it might not. But as far as what to look for in the company, I would submit that an ordinary New Zealander is not going to be able to judge in a way that gives them sort of superior knowledge to everybody else about whether a company's good or not. And so personally, I wouldn't spend hours reading all the documentation because I don't know that it's going to get you ahead. But if you want to, why not? Yeah.
So to summarize, would your view there be more that someone should consider it as part of their whole investment portfolio as opposed to looking at the analytics of that specific company, or perhaps as well as?
Yeah, I mean, this is quite controversial, but I don't really think that individuals can beat the market, do better than average by reading about a company. You can read a lot about a company and establish that it's a strong company, but that doesn't necessarily mean it's going to be good investment, because in fact, Buffett's been quoted on that again. He's a wonderful source of quotes. He said something about when he first invested in Coca-Cola, it was his company, this is decades ago, it was a good company and a good investment. He said it's still a good company, not necessarily in its product, but in its financial strength. Still a good company, but not a good investment anymore because the share price has gone up. So you've got to really distinguish that. If you read the papers about it, you can establish that the company's not going to go out of existence, or seems highly unlikely to go out of existence. But if you read all that stuff and realize that this looks like a good, strong company, so will all the professionals who look into investing all the time, and they will have got well ahead of you and said, hey, this is a really good investment, if it is, gone in and bought the shares. And when lots of people go in and buy lots of big parcels of shares, it pushes the price up. So if you're buying into a good company, but you're paying a high price for the shares, it's not a particularly good investment, is what it amounts to. Yeah.
Yeah, that's a really good answer and overview. Thanks, Mary. Another question from an audience member, Caleb, is: according to recent news, the S&P 500 is expected to drop 6% by the end of the year. Is this concerning for new investors? And I guess that's kind of leads into a bit more of a discussion about the US stock market and the speculative drops that are going to be happening.
Well, first of all, I would say, who says they're going to be happening? I mean, lots of people might say it, but so often people get those forecasts wrong, really. I mean, the US share market's been going up in a ridiculous way over the last decade, since the global financial crisis. So here's the New Zealand market. When you look at the graphs, the New Zealand market's beaten the US one until recently, until the last year or so. Our growth's been even, but they've both been growing hugely. And all the way through that, people have been saying, this is getting silly, market's got to go back down. So look at but I'm not saying it won't. I don't know. I maintain you've got to invest in a way where it doesn't matter. So if you've got money you're planning to spend within the next 10 years, don't put it in New Zealand or American share markets. It's a place for long-term money. So don't we get that novel out, take it to the beach, and don't bother to read the stuff that people are saying. Honestly, I mean, you get every now and then there's someone who's quite famous, often in America, for calling a market, it's usually a market downturn. They were the ones that happened to say the market's going to go down, and then suddenly it does. And everyone says, wow, that person, they really have got it sussed. They've worked out what the American market does. And so they all start putting money into that person's share funds, or, they're often a fund manager. And sometimes 1 in 10 times that happens, that person gets it right again. They get it right a second time. And suddenly they're regarded as an infallible guru, and everybody pours their money into them. And then suddenly it goes horribly wrong. There are heaps of stories like that. People cannot predict what's going to happen to the share market. If you look at what causes changes in a share market, we never know. When a market goes down, the commentators are always saying, oh, well, it's gone down because of COVID, or it's gone down because commodity prices have fallen, or it's gone down because they're sort of searching around to try and explain it. But nobody knows. Nobody goes and surveys everybody who's sold shares that day. So there's a lot of guesswork that's made to look as though people really know a lot more than they actually do. Yeah, be skeptical.
Cool. Thank you, Mary. The next question here is from Rebecca. Thank you for submitting this, Rebecca. It is, what is a good amount to start with initially to get your investments moving and on the right track? Or does it not matter as long as you get started and regularly put money into it? And I guess the footnote there is that at Shareises you can invest from just 1 cent. So yeah, what would your thoughts on that question?
Yeah, and the advent of Shareises and the other similar platforms has revolutionised share investing, and it's fantastic, because it used to be that you really did need to have a fairly big chunk of money to go to an ordinary share broker to cover the brokerage and all of that. So it's fantastic the way that's changed. And yeah, and the answer is you don't need a big amount. What Rebecca was it? I think was mentioned putting in a regular amount. It's a really good idea to put in $10 a week or $20 a week or $50 a month or whatever, and put that same amount into shares or a share fund, regardless of what's happening in the markets. It rewards you in a way that it's called dollar cost averaging, but I think that's a very confusing term. But it's actually quite a simple concept. If you were putting $100 a month into a share fund, and when the market's gone down, you're going to buy more units because the units are cheaper. And when the market's gone up, you're going to buy fewer. Your $100 will buy fewer units at that point. And so in the long run, you're buying more cheap units than expensive units. And that is why it works so well to just don't take any notice of what's happening in the market, just keep putting in that same amount, whether it's set up. It's quite good to just set it up to automatically do that, or you might, set it up, do it yourself. Either way, regular amount in is terrific. Yeah.
Awesome. Thank you, Mary. So we're going to move to our final question now, as we are running a bit short on time. Do you think there is such thing as too much diversification? And that question came from Zara.
Wow, that's an interesting one, Zara. Yeah. Diversification is, such a basic rule in investing. It's hard to actually say that there is such a thing as too much diversification. There used to be before the platforms like Sharesies, because you'd had to have kind of worthwhile parcels of shares in each individual company, but now you can have 5 cents in 1,000 companies, I imagine. So no, I mean, the more diversification, the better, in different industries, not just different companies, different countries. It's really, really good idea not to have all your money in just the New Zealand market. It's nice to have some in our market for sure, and we get a break on dividend imputation on New Zealand shares, a tax break on that. But it's still a very good idea to have quite a lot of your money in international markets, either directly in shares or there's heaps of different funds that invest in a whole lot of different international shares. So yeah, excellent to do that.
Thanks for a really good overview on that one. So we're going to wrap up now. Thanks for tuning in, everyone. And a very special thanks to Mary for joining us. I know myself and all the audience members really appreciated having you.
Thank you. And thanks for a lot of neat questions. It was good. Good fun.
Thank you, Mary.
Pleasure.
Cool. And so for everyone out there as well, please check into our new daily financial news podcast. It's called Recap. It's about 10 minutes long and published each Monday to Friday at 5 p.m. each day on Spotify, Apple Podcasts, and Google Podcasts.
And next Thursday, we will be joined by Peter Beck, who's the CEO of Rocket Lab. And you can register through the link in the chat for that one.
Cool. So we'll see you all next Thursday. Stay safe out there. Have a lovely week. And again, thank you, Mary, for your time. We really appreciate it.
It's a pleasure. Bye.
Thanks, Mary.
Ka kite.